All right. Okay. Well, what I'm going to talk about today is I'm going to kind of give a pre-harvest outlook for corn, soybean, and cotton. I am going to talk about a couple of other real quick things, kind of stuff that's going on in the markets that's potentially of interest. Obviously, we had the 2019 MFP payments. I'll kind of give you an idea of where those payments are in terms of Tennessee. Talk a little bit about prevented planting, and then kind of give a bit of an update on the supply and demand numbers, and then look at a price outlook as we move through the rest of this harvest season. So first thing, just kind of housekeeping issues. The second round, or the second set of payments for the market facilitation program were announced this past month. So again, what we're talking about here are those payments that are a result of the trade disruption due to some of the issues that are going on with China. They structured them quite different than 2018. If you remember 2018 payments, they were based per commodity, so each commodity had a payment rate. So again, if you think of soybeans, for example, the payment rate was $1.65 a bushel. And so you had to end up having your production by each commodity. Corn was only 1 cent, cotton was 6 cents. So again, you had to end up looking at what the production was, and then you would end up getting paid on production. For 2019, this is going to be very different. There's a county payment rate, and you can see on the map here, and I'll kind of show the list and post these numbers up if anybody's interested in looking at their individual counties. But you can see the eligible crops. You have a slew of them. The important ones in Tennessee: corn, soybeans, wheat, and cotton, sorghum again, but there are some other ones. What you do is you take your planted acreage, and again, it has to be planted acreage, and multiply it by these payment rates, and that's what the total payment under the 2019 market facilitation payments are going to be. It's going to be paid in 3 installments, and you have to have producers sign up at FSA between July 29th and December 6th. So again, these are payments that are going to end up coming out or start coming out pretty soon, and then they'll continue into 2020. So if you want to look at individual counties, I know it's a little difficult to look at that map and conceptualize it. One thing that you will notice is some of the cotton counties have a little bit higher payment rates than some of the other counties. So if you look at, take 2 counties, for example, you can look at Soybean County, you know, our largest corn producing county, $73 per planted acre across all those different commodities, versus say Crockett, where you're $125 per acre. So again, there's a bunch of different reasons why they ended up doing that. They kind of did some weighted analysis as to what the potential trade or what the estimated trade impacts were with China. And again, that's how they ended up doing this. The only county that we didn't have a payment rate for was Unicoi County. All other counties are covered with this new market facilitation program. So again, producers, they can go into FSA, sign up, and get their payments per planted acreage. The other one that's been obviously in the news very much and has created a lot of chaos in markets is the uncertainty around prevented planting acreage. And so this is the U.S. total in terms of what was prevented, the percentage of prevented versus intended planting acres. And you can see in 2019, we're roughly double what our highest percentage of prevented planted compared to intended acreage back in 2011. They've only been keeping records on this at FSA back to 2007, so it is an abbreviated data set, but at the same time, there's substantial disruptions. And so again, if we look at kind of our traditional row crops, our corn, soybean, cotton, and wheat, there was 19.26 million acres total. There's 95% of that in 4 crops. So if you look at corn, 11.2 million acres, soybeans 4.35, and cotton just under 500,000. Wheat again is spread over multiple seasons because you have the winter and the spring crop. Spatially, what it looks like, this is for corn, and you can see the legend at the bottom, anywhere between 1 to 5,000 acres in the light yellow to up over 50,000 to 115,000. There's a bunch of areas that I do kind of want to point out. First is kind of this prairie pothole region, South Dakota, Minnesota, substantial amount of corn acreage that went into the prevented planting. And then again, the Eastern Corn Belt, where you got into Illinois, Indiana, and Ohio, where we've seen substantial amounts of prevented planting acreage for corn. If you look at soybeans, you got to remember less acreage. They've changed the scale down here so that there's not quite as much. But again, you see that pocket in Ohio and Indiana, and then also in South Dakota. You look at cotton, again, what you see is you see a bunch in Arkansas and Mississippi. Obviously, in Tennessee, our counties that bordered the Mississippi were the ones that were most dramatically affected in terms of cotton and corn and soybeans. So again, we've seen a substantial disruption in what the number of acreage relative to intentions were. Now, one other thing that's really important to kind of look at this from a marketing standpoint is the first thing that jumped out to me when this report was released was why so many corn acres. And so if you look at where current estimates are, they're estimating that there's about 90 million acres of corn that's going to be planted in the U.S. Well, if you combine that with 11.2 million acres on that prevented planting report, and again, you have to remember now we're dealing with numbers that I'm not saying are rock solid, but you're talking about the FSA numbers that have been reported by producers. We're probably going to see a little tweak to that 90 million acres, but I don't anticipate a substantial change. But if you add those two numbers together, what you come up with is 101.2 million intended acres, but that's a little misleading. And a big reason for that goes back to looking at the crop insurance and how it played a role in what was certified or declared to FSA. And if you take simple examples of what a crop insurance prevented planting indemnity payment would look like for each one of these commodities, take an APH, I just pulled random numbers here, 170 bushels per acre. The projected spring price for crop insurance was $4 a bushel, buy-up coverage of 75%. If you just ended up keeping the base prevented planting factor of 55% for corn, you'd end up seeing a $280 per acre payment. Compared to soybeans at 55, 954, still 75%. The factor for soybeans is 60%. That'd be 236. So there was an incentive for people to say that the corn were the ones that were not planted over soybeans because it would yield a higher payment. And so again, there is some. It's not. It's just a question of which acres, you know, as they adjusted their decision when it got planting, that you were ending up getting payments for. And that's why we ended up seeing such a discrepancy between corn and soybeans, 11.2 and 4.35. Now, obviously, you can't just go in and say, well, I'm just going to certify the acreage that I want. That's not how it works. There are some restrictions, but there is flexibility within the crop insurance program to say which acres you were intended to plant. And so this did have dramatic implications for the market. Obviously, we'll talk about prices in a little bit. But there's a lot of people that were expecting a much lower acreage number than 90 million acres planted for corn, and that was reflected in the futures market, where we've seen December corn futures get up over that 450 range, and it came down very rapidly once we ended up seeing some of the data that ended up coming in. So again, just how does that affect both global supply and demand and domestic supply and demand? I'll kind of step through that quickly here. So first we look kind of at the global outlook right now. This again has your ending stocks, your production and consumption. So your production is the red line, your consumption is the black line. So if you look at where we're at right now, we're estimated to end up having about 12.1 billion bushels in terms of ending stocks, and that has decreased since 2016, which bodes well for price prospects. Now, there are obvious issues in accessing global markets right now that does provide some challenges in terms of marketing corn, soybeans, and cotton. So again, we haven't necessarily maybe seen some of the long-term benefits that might potentially arise from this reduction. Additionally, you have some real severe concerns, and Andrew might touch on this a little bit more. On the demand side, when you start talking about issues with African swine fever, not just in China, but in several other countries. And so when you look at the potential pullback from feed demand, that's problematic. If you look at the U.S. picture right now, Again, what we've ended up seeing is where we've got consumption, which is both consumption, domestic consumption and exports currently exceeding production. So again, we are still looking at ending stock somewhere north of that 2 billion bushel range, which doesn't bode well for prices. Now, a lot of that is going to be contingent on what our domestic yield is. The USDA has it estimated right at 169 bushels per acre, which is slightly below trendline yield. But again, it's not as low as a lot of people were anticipating. It's going to be really interesting moving forward how we end up seeing yield estimates adjusted. A lot of it is obviously due to the lateness of the crop planted in much of the eastern corn belt. And then also as you look at fall weather, if we do get an early frost, particularly in several of the northern states, that could be really detrimental to where we see production. So there's still a fair bit of production risk that's out there for the domestic crop. And so there could be some opportunities to end up marketing as we move forward. If we look at cotton production, I'm not going to spend a ton of time on cotton, but cotton prices have really deteriorated. A lot of that is due to kind of stagnant consumption. What we've seen is global demand kind of really level off. We did see that big reduction in stocks, but again, what we're looking at in 2019, and the biggest issue that we've seen is in the domestic side. So if you look at U.S. cotton production, we're projected at 22.5 million bales. That's going to be higher than where we've been since 2010, and obviously we've seen prices come down substantially from where they were this past fall when we were well up over 75 cents. We're now down right around that 60-cent range. It's going to be really difficult if we hit this 22.5 million bales to see a substantial rally in cotton prices. You look at soybeans. Soybeans again, you see that consumption at 13.02 billion bushels. I think that is potentially high, and a lot of it revolves around that African swine fever issue. When you're looking at what the potential ramifications are there. Again, we've seen a dip in production. A lot of that is driven from U.S. production declining, which could end up assisting prices. Now, again, we run into the same issue that we've been battling for the last 400 plus days, where we've been in a trade dispute with China. Without resolution or access to that market, there are some really severe limits as to how much prices will be able to move. You look at U.S. Production and consumption. Again, what we've seen is that dramatic decrease. A lot of that's due to planted acreage being well lower than where it has been the past few years, and that corresponding production decline. So again, one thing that it does assist in is it does kind of indicate that if we do have kind of trend line yields where they're estimating right now, we could see a reduction in stocks, which would be positive for prices. But if you look at where we're projected for the 2019 crop, 750 million bushels, we're still way higher than where we have been in past years. And you can see the corresponding prices along the bottom in terms of what the marketing year average price is for the U.S. And I'll get into kind of some of the differences between where the U.S. marketing year average price is and what we can expect relative to Tennessee. So if we look at prices, this is the December corn futures chart. And again, for those of you that maybe don't look at futures charts as often as me and Andrew, each one of these little lines, these vertical lines, are the daily movements in that contract. So again, that's the high and the low is the length of the bar, and these little ticks on either side. There's kind of a little notch on either side. If it's on the left-hand side, that is where it opened, and on the right-hand side is where it closed. So you can see when we had that WASDE report and the prevented planning report come out, we ended up having a limit move down. So we moved a full 25 cents lower on the release of that report, and then we had follow-through selling, where we've ended up coming in right in between that kind of 370 to 380 range is where we've kind of settled. We haven't set a new contract low. We did have that low back in May, but again, I suspect that we will move sideways and probably largely trade a weather market now that will be varying expectations due to yield more than acreage. the acreage uncertainty that we'd seen the last 2 months prior to this report was substantial. I suspect that yield will be the primary focus, and then as we move into harvest weather and fear of that potential early frost as well. We look at soybean futures. We've seen a tremendous amount of volatility. One thing that we've kind of seen I guess, slow down a little bit are those dramatic jumps due to trade-related news. There's a lot of people now that think that this is going to be a much longer-term issue, and markets aren't moving as dramatically as they were based on positive or negative progression with trade talks with China. There's a lot of people that are suspecting that since we've kind of pushed this into the fall, it seems unlikely that we will get a long-term resolution as we move into the election season. It's not completely out of the question, but I think there's a lot more expectations that where we're at right now is the status quo. And so if you think about it in terms of what that does for marketing opportunities, obviously South America is going to provide a lot more soybeans to China than U.S. sources if we are able to access that market. But that does provide us the opportunity to backfill some of the other countries that maybe traditionally buy from South America. So again, putting some soybeans into Europe, some of the other Southeast Asian nations that would typically buy from Argentina and Brazil due to lower prices in the U.S. may be looking to source soybeans here. Now, we're not going to replace Chinese demand. There's no country or group of countries that are going to be able to end up taking that burden. But again, it does give us some opportunities to grow some export markets and hopefully establish some trade relationships that can be beneficial long term. Because one of the big concerns that are out there right now is even if we do get a resolution with China, we're not going to just snap back to where we were. There's going to be a new market norm that will emerge. And it's really challenging to understand where that potentially might be. Will we be able to export or recoup the market share that we've lost? And so there's a lot of moving parts there. And when you throw in that African swine fever issue, which it is incredibly difficult to get good, accurate numbers about what the potential losses out there and how long it would be potentially detrimental to rebuilding some of these hog herds in China and other countries that are affected by this disease outbreak. And so it adds a huge amount of uncertainty in terms of demand. And when you're talking demand, that pull might come from South America, but you're talking about one bucket of soybeans, more or less, that if you have a tremendous amount of reduction in demand, that could be very disadvantageous to prices. You look at what we're doing in basis right now, and again, this has both soybean basis on the left-hand side and corn basis on the right side. So this is the average basis in red, and this is the monthly average basis from 2013 to 2019. So again, what you will notice is what we've seen basis weakening as we move into July and August this go around, and a lot of that is due to that uncertainty with export demand. Corn, we've actually seen reasonably consistent basis behavior where we've seen our typical seasonal increase in basis. One thing that I would caution people on is given our crops are looking good relative to the rest of the country, we have more acreage than we did last year. What we are likely to see as we move into the harvest interval is a softening of some of the basis. And a lot of that is just due to, basis captures the local supply and demand. But if we have more acreage and we have good yields, there's a good chance that we're going to see a softening of basis relative to where we normally are. Again, if you have the ability to store that crop, it provides seasonal opportunities to take advantage of price improvements as we move, particularly for corn, into the new year. Soybeans, again, what we end up seeing, since most of our soybeans have to end up leaving the state either down to Alabama if you're in southern middle, or if you're going out on the river out in West Tennessee, we don't have domestic crushing at this point or in-state crushing. And so again, we're typically subject to a weaker basis. If you look at where we might see corn prices going, so right now, one of the things that economists like to track is stocks to use. So again, we look at how much of a product we end up having relative to our use over time. And so I took a look at since 2000, what we were looking at in terms of national farm level price. And you can see kind of some of the years that are out there, and then also the trend line. And so if you look at where we're projected right now is right around 15% stocks to use ratio. I think that we'll see that kind of pull back, because I think there'll be a little bit of yield and acreage reduction. But again, there's a demand factor in there too. But a reasonable national average farm price to expect is somewhere between that 3.5 and 4.25. Pretty wide range, but there's a lot of time between now and harvest. National farm price maybe doesn't do as much good as looking at what's going on in Tennessee in terms of making decisions. So what I looked at is from 1980, I looked at what corn and soybean prices in Tennessee did relative to the national marketing or average farm price. And so the way to read this chart is to end up taking a look for soybeans, for example. 0 would mean that Tennessee and the national marketing or average price were identical. And that occurred 2 times. But what you can see is there's definitely a skewedness to the positive side. So again, when you look at corn on the orange bars here, what we're looking at is typically we're somewhere between 10 up to 30 or 35 cents higher than what the national marketing or average price is. So again, when we start looking at that, we can start incorporating that into kind of what we're looking at in terms of expectations. Now, given the fact that our crops are looking reasonably good relative to the rest of the country, we would probably anticipate that we are going to be probably on the lower end of this distribution. It's not impossible, particularly for soybeans, that we would end up potentially being lower. Now, I don't necessarily foresee that happening, but I don't think that we're going to be up in this upper end of the price relative to the national marketing year average. Switch it up to cotton. Cotton's a really challenging crop right now from a marketing standpoint. You can see where prices are down below 60 cents on the December contract. It really limits what producers are able to do in terms of marketing that crop. Unfortunately, given where some of the production estimates are, I don't see a substantial improvement in cotton's fortunes unless we see an adverse move in weather that would potentially affect the estimated production of 22.5 million bales in the U.S. You look at similar graph as what I end up presenting for corn and soybeans. Typically, our marketing year average price in Tennessee is pretty much close to what we see in terms of the U.S. marketing year average price. So some years will be a little bit lower, some years will be a little higher. But again, you don't see a skewedness one way or the other in terms of what that average price is going to end up being. So if we look at kind of price outlook right now, there's still a tremendous amount of uncertainty in corn and soybean markets. A lot of it's going to depend on how yields end up continuing to progress. So again, if you look at kind of where we're talking in terms of cash prices, $350 to $425 as we move through the rest of 2019, looking at probably a little bit more muted basis improvement as we move into 2020, just because of the estimated size of our crop. Again, it's not in the bin, so you don't want to jump to questions, or to deductions that might not end up materializing. But again, that's a reasonable estimate of where to look at marketing that crop. A lot of it's going to depend on the region that you're in Tennessee. Obviously, there's certain parts of the state that get traditionally higher bids for corn, strictly on the strength of poultry and demand, particularly in Middle and East Tennessee, where you're probably at the upper end of that range. If you're out in West Tennessee, you're probably looking closer to the lower end of that range. I didn't talk about ethanol today, but there are some potential issues there that might soften some of the bids when you go up into the northwest part of the state. If you look at soybeans, again, that trade with China just kind of won't go away. It kind of just hangs over top of that market, provides a wet blanket in terms of any price rallies. So if you think back to the U.S. supply and demand chart, that dramatic decrease in production should have triggered a larger price reaction than it did. But due to the fact that you can't access large global markets, you're going to see it much more muted in terms of any price recovery. The other one that those two kind of go hand in hand is African swine fever, where again, we don't really have a great idea of what that short and longer term demand for feedstuffs in China is going to be because of the disease outbreak. You're talking a substantial amount of hogs. You know, you've heard estimates anywhere between, you know, a third to a half of their hogs being affected. Well, that's a tremendous variation in what the expectations for feed would be. You have South American production that is lingering in the background as well. Obviously, Brazil and Argentina can take advantage of accessing that Chinese market. They also are getting a bunch of investment from some large Chinese companies into their infrastructure, which to me is a real warning sign in terms of long-term ability for the U.S. to recoup that market. You see a whole bunch of infrastructure go into into those countries to assist in getting crops to port. That's something where they're going to expect a long-term return on that investment. And so the more we see those types of reports coming out of South America, the more concern we should have about recouping that soybean market. Cotton, I mentioned, is really a challenging commodity right now. It's also affected substantially by trade. South American production is also another one that is really important in cotton that hasn't been as large as it normally is. What they're doing now in cotton is they're able to double crop cotton behind soybeans. A lot of it depends on how quickly they can get that first harvest out. So when you're looking at the South American production season, if they can get soybeans out in January and February, then they can follow that with a cotton crop and planting right behind soybeans. So again, you have the more traditional soybean corn double cropping system, but now you're seeing cotton. And again, a lot of that is driven by the fact that they can export direct to China, so they have an advantage over U.S. Producers without having to end up paying those tariffs. But again, where we're going to see cotton prices somewhere between 55 and 65 cents on the future side. So again, that's going to be a challenging marketing environment for cotton as we move into end of 2019, early 2020.